So in this series of screencasts, I want to talk a bit more about time series, and in particular how to spot and measure change in those time series in terms of trends, regular fluctuations and irregular fluctuations. Now, those are the three types of change that we can be looking out for, and I'm going to briefly talk through what those mean in more detail. So a long-term trend influence that we were looking at in our data would be something that either a growth or decline over the long term in our variable. So, for example, if we were looking at the number of deaths in England between, let's say, the early 19th century and today, we would probably find that if you adjusted for the number of population, that the death rate has declined over time. So that would be a long-term drop, a long-term declining trend in our data. Conversely, if you looked at GDP over time, that same time period, you'd find that consistently there was a long-term growth trend in the upwards direction, that GDP has been increasing even when we adjust for inflation. The second type of change we could be looking out for are regular fluctuations around that longer term trend, and that could be caused by seasonal or cyclical variation. So, for example, if we were looking at the number of deaths in England, again, we would expect the numbers perhaps for the winter month or the winter quarters to be higher, and so that we'd have lower numbers in the summer, and then higher numbers in the early months of the year, let's say, and that would be that wouldn't disrupt the overall long-term drop in the number of deaths, but it would give us a kind of irregular pattern that was a regular pattern of higher deaths at the end of each quarter. If we divided the year into quarters, higher deaths in Q4. Equally, it could be a longer term thing than just a year. So thinking about GDP, traditionally economists have identified kind of boom and bust periods. So over a period of, say, 5 years of growth, you then get a sharp decline in growth for a number of years before you then get another bigger growth rate again. And actually the overall long-term upwards trend is made more in terms of a series of kind of bumps along the way in a fairly regular cyclical fashion. So the long-term trend, there might be some interesting kind of regular variation within that long-term trend. The third type of change over time we need to pay attention to, I think, are irregular fluctuations. And those are generally short-term and normally unrepeated kind of drops or increases in our variable. And they might be caused by things such as like wars, disease, that people then develop an immunity to, or changes in government policy. So, for example, we'd expect the death rates to experience a big increase when the world wars were fought, and actually just after the World War I, we have kind of Spanish flu. If you're looking at some European countries, and indeed the US, you'd see some big increases in the number of deaths that were kind of a one-time variation. Similarly, thinking about GDP over time, you might hypothesize that if a government policy was particularly effective, you could kind of see a one-time increase, or perhaps if it was really ineffective, a one-time decrease that was outside of those normal variations and longer-term trend. So those are the three types of change we're going to be looking for. So long-term trends, regular fluctuations, and irregular fluctuations. And it's up to you to use your academic judgment as to which of those is responsible for your data, the variation you're seeing in your data, or more likely, which combination of those. So is there a long-term trend? Is there any discernible regular fluctuation within that? And are there kind of any outlier or irregular fluctuations that might be linked to specific events? So how can we put this into practice? Well, I would suggest the first step you should always take is to sort your data into chronological order if it isn't already. And I like to do that from oldest values at the top and newest values at the bottom. And the next step after that being to actually just graph the raw data as a line graph to see if you can spot anything visually. Now, how I'm going to approach showing you how to do this in Excel is I've got some data here from Quandl, which I've mentioned to a couple of you, and on the Blackboard site. Now, all Quandl is a kind of data repository, or a market for data, and a lot of their data is commercial data that they try and sell you and get you to sign up for, but they also host, in a kind of easy to access interface, a lot of public data sets which are available for free. So for example, if you go databases and then search by provider, you can find the United Kingdom Office of National Statistics releases here, and here you can see, for example, this one is a time series of ice cream. I don't know whether it's sales or price of ice cream. It's obviously on an index at 100. So you can get the stuff and you can download it. You have to sometimes log in through your Google account or university account or create account with Quandl, but it can be quite easy. It's worth saying that the same data for this is normally available on the Office for National Statistics actual site, and you don't have to do any logins. You can just get the chart straight away as CSV or an Excel file, set the time period and kind of regularity that you want, or whether you want it as a chart or a table. So you can just go and get it directly, but I wanted to quickly show you Quandl as well. Now, the one that I've been using is actually hydrocarbon oils, which sounds a bit boring, but I want you to focus on what we're doing with the time chart, not necessarily straight away on what this actually means. So I've chosen something a bit unusual, and what it effectively is a measure of hydrocarbons or oil, so kind of petrol, crude oil for aircraft fuel or diesel. So basically it's a measure of kind of how much of that has been extracted or brought to the and used by the UK. Okay, so all I did was click download and I got it into Excel, and it looks like this. We're not going to worry too much about what units these are. We're just going to use this as a general measure of kind of how much oil has been used in the economy over time. So the first step then is to sort this into date order. So I'll just check that we can set this as short date. You don't really need to do that, but it's just a bit of a safety procedure to make sure Excel definitely interprets it right. Set that to number, and I'm going to reduce the decimal point back down. There we are. And now you should know how to do this from previous videos. We're going to sort this one, and because it's a date, it's going to tell us, give us the option of oldest to newest. Expand the selection so the other values move with it. And there we are. So we've got data starting in 1970 and going up to 2015. Well, that's great. So let's do a quick line graph of this. So I'm going to start by highlighting the values I want it to chart. Insert line graph 2D. Move that up there. And go select data. I could press edit here and put the titles and things in, but I'm just going to go edit on the horizontal and just give it the dates. I'm only doing this as a quick thing rather than for a report or presentation. So there we are, we can go. Hydrocarbon oils, great. Okay, so the basic story of our time series then looks like it's going to be one of a long-term growth in hydrocarbon oils. And we can see that goes from not quite, this is potentially a bit misleading because this figure is actually over 1,000, but it's pretty near the zero compared to where we are by the end of our series of 27,000. So we always need to be careful that this doesn't, the size of our kind of axes, our y-axis ticks here, so how regular they are, could deceive us and make us think this number was a bit lower than it actually is. But the long-term trend looks like an upwards one, sloping up from the left upwards to the right, and that indicates a long-term growth over time. If on the converse we had, conversely, if we had from the left over here a slope that was heading down to the right over here, this would be a negative growth rate, or in fact, in general terms, we just call a decline, okay? So the other important thing to note is the steepness of this curve indicates the rapidity or the rate of change over time. So clearly we can see here, things aren't moving very fast. The slope is relatively flat, whereas actually there's it gets increasingly steep as we come up to the 2000s here, and with a little dip and then a slightly abated pace of change increase over time towards 2014. So the rate of change has been different at different points in time, although of course because we've kind of zoomed out to see this, this may very well look quite steep in terms of the smaller numbers that we're dealing with here. So again, it could be misleading because we're looking from the perspective of a clearly very rapid period of change in the middle of our time series. And this is really the first step question you need to answer. So what's the growth rate? Has it been what's the direction of growth? Has it been has your measure been growing or increasing over time or decreasing over time? And then has it been a completely steady process, or have there been periods where it's been faster or slower growth or decline? So to do some more quantitative analysis as opposed to a kind of visual check, which you should do first, we can really use two measures of a growth rate. Now, growth rates can be positive or negative, as I've been talking about, and really for all of these measures I'm going to talk about, the choice of the period that you're going to be assessing is crucial and can distort your findings significantly. So if we decided to start our growth for this period down here, so we're only looking from 2002, and we chose 2002 up to 2014, well, that would look more dramatic potentially than if we started the year before when we were in a high and took the growth rate from here. This isn't a very good example necessarily for showing this, but if we had a graph where, let's pretend we had death rates, for example, in the UK per 1,000 people or something, and they were generally coming down, but actually there had been a kind of huge drop at some point, and then everything had gone back up again. Well, if we chose to start in the lower period here and just measured that to the end, that would be significantly distorting our data. So you need to be really careful about where you choose your start and end points when you're talking about growth rates. Now, there are two common measures for growth rates. The first of them is called the mean increase per year, and the second is the average percentage growth rate. Now, we're going to deal in this video now immediately with the mean increase per year. And essentially what that is the difference between the last and first values divided by the number of yearly observations. And it's fairly easy to calculate in Excel, so I'll show you how to do that now with a formula. So all we want to do is take the last value in our series, or the chosen subset of our series, and here I'm just going to be taking the first and last that we overall have, not a subset of the series. So in our case that is going to be the value that sits in B47, and I'm going to minus off or subtract the first value of our series, start value, which is obviously sitting in B2. And I'm going to close the brackets, so we do that first. And I'm going to divide the result by the number of yearly results that we have here. Now, I could just work out that there are 46 years in this series and manually put 46 in here, or I could use a bit of Excel magic and use the count function and give it the range, which is B2 to B47. And that'll do it for me. And just for check for you guys, I'll show you that count gives us the value of 46. So just counting how many entries there were in this time series. See, there we are. So our mean increase per year is 566.2609 or whatever. Okay, and this is in the units of your graph. So if we put this into something easier to understand, if this was kind of number of deaths per year, this would be the average, the mean increase in deaths over that time period every year. So each year would have seen, if you use the mean average, an increase of about 566 deaths. In our case, we're talking about a measure of how much oil has been used in the UK economy, and it's gone up every year by 566. So for whatever time series you're using, one of the first things you could do is look at the mean increase per year, but there are some limitations. So, for example, this measure is obviously completely dependent upon what values we chose for our start and end, or where we chose to have our start and end years. So, for example, if I was, because I've done this with a formula, if I changed this up to be nearer the overall value, so 30,000, you'd see that actually, despite this longer term story of kind of a theoretical decline and then growth back up to it, all we end up with is a growth rate of negative 56, because it's just looking at the average, the difference between the first and end values, and averaging that, presuming that that was kind of a direct line connecting those over time. So what this is describing is if, in theory, this line, instead of going on this long other journey over here, had just taken a direct route to the slightly lower value of 2014, so it's kind of been all along here, and that would have been what it's describing there, just a drop every year of 56 would describe this straight line along connecting the two dots. So if I undo that, the other thing, of course, is that it completely ignores what's happening in the middle of our series, okay, because it's presuming that straight line connecting the start and end values. So if I was to put a ridiculous value in here, kind of off the scale, you know, up to, well, let's not go quite that high, but 40,000, 45,000, something like that, we see a huge bump in the road here, but our change over time calculation for the mean increase per year has barely changed at all. It hasn't changed at all. It's unaffected by changes in what goes on in between those start and end values. A final limitation comes from the fact that this is expressed, our result is expressed in the units of the thing that we were measuring. And the problem with that is it means it makes it very difficult, or actually pretty much impossible, to make direct comparisons between different change over time series. So for example, let's say I wanted to compare this oil one with the production, I don't know, of say paint, which relies heavily upon oils, or let's say the production of car ownership or something like that. The units would be different, and therefore we couldn't make any direct comparisons between these changes over time. Now, one way of solving all these differences, or at least some of them, is the average percentage growth rate, which we're going to look at in the next video.